When dealing with your taxes, you might have a lot of questions and it could be a little confusing. So today we are joined by Julie Newton with Market Advisory Group to help answer those questions for us. Good morning, Julie. How's it going?
It's going great. Good morning.
So Julie, can you tell me a little bit about what's the difference between a Roth IRA account and a traditional RIA account? For me, it's like a different language almost.
It is, and you know what? It is for a lot of people, so that's okay. So the difference is a traditional IRA is money that you've contributed pre-tax, and what that means is when you take that money out, it's taxed as ordinary income. A Roth IRA is an account that you've contributed to after tax, which means you've paid the taxes, which means you don't have to pay taxes when you take a distribution. Where that really comes into play is there is something called a required minimum distribution that starts when a person is at age 73. And so you have to take money out of that traditional IRA and pay the taxes on it every year. With a Roth IRA, you don't have that required minimum distribution because you've already paid the taxes.
Okay, now let's talk about ETFs. Are they a good vehicle for retirement?
So, you know, a lot of people get under the impression that certain investment vehicles are sort of a one-size-fits-all kind of thing. An ETF is one that a lot of people consider that. It's kind of a cross between a stock and a mutual fund, but the key being that it does have exposure to market risk, those ups and downs and you know, those really big downturns in markets. So it's important to understand if that ETF is the right investment vehicle for the person. There is no one size fits all. It's important to sit down, go through, you know, what the needs are of each person, so you can make sure if that particular investment vehicle, ETF or otherwise, fits what they're trying to achieve.
Okay, I know a question a lot of people have is about their pension. Should they take it as a lump sum?
That is, it kind of depends on what the person is doing in terms of that lump sum. So you kind of look at it two different ways. A lump sum distribution, if you're taking all of it out in cash, that's something you want to avoid, because when you take it out in cash, pre-tax money, tax consequences, which can be pretty significant. If they're talking about a lump sum as in a rollover to an IRA, it's considered a qualified transfer, and therefore there are no tax consequences. So it's important to talk to a financial advisor and a tax professional before making a decision whether to do a lump sum or not.
Ask Our Advisor on Kansas City Spotlight has been paid for by Market Advisory Group. For more information, visit marketadvisorygroup.com.